Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, March 13th, 2019. In this video, I want to cover several bond ETFs and look at the different types of bonds. I had intended to cover TLT, which is the long-term Treasury Bond ETF, in the market update video today, which also had some coverage of a few agricultural commodities as well as oil, so we had commodities in that one. And didn't get to TLT, so I somehow missed that one. So we'll go ahead and cover TLT as well as LQD, the corporate bond ETF, JNK, junk bonds, and maybe even take a peek at commodities. Every now and then I'll do a video talking about asset allocations and the benefits of that. It is widely considered one of the most important things. In some cases, some studies even more important than security selection. Security selection is what you buy and sell, what stocks, whereas asset allocation is your mix of various assets, stocks, bonds, commodities. So you have bonds being one asset class, and within bonds you have different types that behave differently and different makeups. So we'll get to that. We're not going to do a super in-depth deal. We'll just kind of touch on the main ones: treasuries, corporates, and then high-yield corporates, which are AK junk bonds. And again, time permitting, I'll just touch on some of the commodities, the kind of bigger picture. But let's start here with TLT, since this should, treasury bonds or bonds in general will typically make up, a portion of someone's portfolio. The younger you are, the longer your time frame, typically you'll have less in bonds, possibly none at all. But the closer you get to retirement, or even if you're investing long term and you're not, a very aggressive investor. Again, I've done a whole video on that. There's a lot of studies that show you can actually enhance your returns with a mix of stocks and bonds, and bring down your risk overall. So I think they do make sense, and a lot of you out there have 401k type plans where you only have a few options. You can either be in the stock market via various equity funds, US or international. You can be in bonds, or you can be in cash, and that's usually about it. If you're lucky, you might have a commodity fund in there, but for the most part, that's it. Stocks, bonds, and cash are your three options. So we're going to go over those, and we'll start out here with TLT. Again, this is the most popular, most liquid long-term, says 20-plus year Treasury bonds. So that's 20 to 30 years. The U.S. That's for many years now. They used to, I think, for a while we might have had 50-year bonds, but for the most part, that's the 30 years are the maximum maturity. And so they're holding bonds, and some of the bonds that they bought may have been 30 years initially, and we're 10 years into it now, so they may drop out of that 20-year range, and then they'll move it over to IEF, which we'll get to in a second. That's the intermediate term bond fund. All right, so bigger picture here is this uptrend line. By the way, we are looking at a weekly chart. I just want to go over kind of the big picture, not do a super in-depth video on bonds, just touch on them. So here's a 10-year weekly chart. You can see the trend line, pretty well defined, reactions along the way. That was our primary uptrend line, and that broke in early 2018. And as you can see, we've been, for the most part, in this trading range right here. So that as of now is really where my main focus is. And again, this is a weekly chart, so nothing is going to happen today or tomorrow is going to change much on this chart. We had a brief spike down leading into October market top. See, that was, again, remember when the correction started, I pointed out a very unusual disconnect where we started to correct, and there were a lot of non-believers in the correction, so they weren't buying treasuries, and that's when we went long treasuries, saying that, trust me, the market drops a lot, continues to drop, you will see a flight to safety, and that's what we got. So we had a nice lift, and bonds, for the most part, particularly the corporates, and of course the junk bonds, have been rallying along with stocks. So year to date, bonds have been a good trade. Just about everything. It's been a reinflation trade on the market. The only thing lagging, there's some commodities that are not really participating, but so for longer term, here's what we're watching. So I mentioned that boxed in area. A break above that would obviously be bullish, and that's about 122.60, give or take. Again, you'll need to see a solid weekly close. Sometimes you get a little pop like that right there, that candle, and we close back down below it for the week. So while you have this trend line broken, which is pretty significant, and that would be longer term bearish, you have this bullish falling wedge breaking out. It's a smaller pattern, but that's intermediate term bullish. So we went here, we had the divergent low, and again, this also confirms or helps to confirm a intermediate term bullish case. Just like you had a divergent high right here with negative divergence down on your indicators, divergent high here. These things do work, and again, not 100% of the time, but much more often than not. I would say well over 90% of the time when you have nice clean divergences on a weekly chart, you're going to get the major trend changes. And same thing here with the divergent low. So that's it. We had a breakout, we hit resistance, and we've been consolidating under that resistance, so that's what we're looking at. If we can pop that level anytime soon, this remains, and it has been for weeks or months now, a swing target to come up here and back test that trend line from below, and or that 128.50-ish level right there. So that's the outlook for TLT. That's been back testing, and it could continue to back test. As I often say, resistance is resistance until and unless broken. So you have to watch that, and I'll get to the daily chart here in a second to try to hone down a little bit if you're trying to make a more of a tactical trade on treasuries. I think it just makes sense right now, especially with the outlook for the stock market, despite what's going on today or earlier this week. I still think the the risk reward is pretty lousy, at least not very favorable. And so at that point, I would think even an aggressive investor might want to kind of hedge up a little bit in 401k type money. And then what you can do there is have every pay period change your allocation so you don't have 100% going into stocks or 100% into cash, which is giving you virtually no return. You can allocate a little towards treasuries. So far it's worked out year to date. They're certainly up, especially off the lows in December. And let's look at the daily chart real quick. Okay, here's TLT on the daily chart. Let me flip boards here real quick. Same story. This was the last trade that we did, last official trade idea. And I had this originally that was a former target right there. Now this is pretty significant resistance. You know what? Let me do this. Let me just turn off the annotations here, the drawings, and show you. So on the weekly, I showed you that boxed in range, if you will. That's our trading range, and it is. I'm going to start the line back here if I can get the right tool. Let's try it again. A box tool, and show you that is pretty much the the resistance line. At least right there is resistance. We'll call this right here the recent trading range with a brief dip down below. And again, everything was, all the check marks were in place for the long trade, the divergences at the lows, everything else, plus the expectation that the markets would continue to correct in the fourth quarter. So that led to that sharp rally. So now where are we at? This is a pretty, as you can see, we have a lot of reactions from above, a lot of reactions from below as well, and which makes that a pretty decent level, pretty significant level. And every now and then you get false pops, false breakouts. This is one thing, when I did the video today, we might see this in the S&P 500 if it pops those highs that it's been failing at for the last few weeks. That's what a bear trap would look like. However, or a bull trap. But this one's been resilient. Yeah, they did fade that pop right there, but then they came back up, and it's been persistently tapping on that. So if you want to know my thoughts, first and foremost, like I always say, resistance is resistance until unless taken out. So is it objective to go long right now, TLT? No, it's not objective to go long when something has rallied up a pretty sharp rally right into resistance. But what I can say is the market is at a point where, although anything can happen, and it does, there's not, super bullish if the market goes up another 2 or 3% from here, super bearish if it doesn't. It's not that easy, but right now it is at a point where, looking at a lot of things on the charts, if it's going to reverse and have another big leg down this year, especially at this point in time in the coming months, it should happen soon. And so if it does, where I'm going with that is keep an eye on treasuries, because if the markets suddenly start to sell off hard, and let's say by chance, right now, it doesn't look like it's going to happen, but it's still, we're only halfway through the week. If those bearish engulfing candles get confirmed, we reverse, we close down, down at or below last week's candlesticks on SPY and IWM and the Dow and everything else, then what you would probably see, that would be a very bearish event in the equity markets, and you'll probably see a continued flight to safety. If you've noticed, and I think some people have pointed out recently in the trading room, I know I have as well, there has been a lift, a pretty sharp rally in Treasury bonds with the stock market going up this week. Now, why is that? Usually you see Treasuries going down when stocks are rallying, so this could be institutions moving in. Bonds go up and down for mainly two things: safety, as a flight to safety instrument, and also as on expectations of future inflation or lack thereof. So this could be rate driven. We'll see. It could have to do with Brexit. Who knows? But those are things to watch for. And so that would give you, again, if you start to see, especially equities take a dive, and then you see a breakout here, that could open the door for the next leg up in Treasuries. Otherwise, they could fail here. If the market breaks out and clearly puts today's highs in the rearview mirror and continues to rally, you'll probably see money come out of Treasuries. That would be a flight away from safety bid back into equities. So that's where we're at. I can't tell you which of these scenarios are going to play out, but I can tell you to watch that because it's a pretty significant level. And again, long-term stuff, this is daily. This is, again, we're talking if you have a longer-term strategy in your asset allocation, this is what you want to watch. If you're a swing trader or you want to try to tactically add on to your positions and Treasuries, you can trade off the daily charts and maybe even the 60-minute charts. So let's look at IEF, and then we'll look at the other types of bonds. IEF is the 7 to 10 years, so we call this the intermediate term Treasury bonds. And you can see here we have a nice downtrend line, bullish falling wedge. And again, so this is where, all year if you've had 401k funds in here, you're actually making money at the same time stocks are going up, which is sort of interesting. So they've rallied again. It's been a reinflation trade in the markets, oil going up, both Treasury bonds and stocks going up. And again, it was technically driven. We had the bullish setups and oversold conditions in the equity markets, and you can see here on IEF that you had, and this rally started before. Obviously, this rally started closer to the top of the market in IEF, or let's see if I can. The very bottom came on October 5th. That's when the markets topped. And so what happened is IEF wasn't doing much. It took a while, and then we hit that point of recognition there in early December, and that's when Treasuries really took off. However, they've continued to advance since then. So there's your resistance. Again, this is a weekly chart. We do have the PPO up in bullish territory. I should have made mention on TLT. I had it circled, but I don't think I pointed it out. That's one thing I was watching. We're just barely above there. It looks like it's starting to roll over, and I use that as a trend indicator. That white line, if it's above or below, helps to indicate a trend. It's been a little whippy here, so when I see a lot of whippiness, in other words, not clean separation above or below the line, and that's what you get when prices start to compress, this is not as reliable a signal. But on IEF, you have a little more separation, and you can see it there. Plus, you had strong divergence at the lows. So based on look at this chart, I think IEF will likely continue up there. It may not be a straight shot, may come back in before then. Again, a lot will have to do with what the market does, but I can tell you that looks like a pretty decent resistance up there. Not super solid, but decent, around 105.81, and possibly work our way up here to about the 109 level in the coming months, because again, it's these divergences that kind of give you an idea. They're not all marked on here, but you can see nice clean divergent high right there, followed by trend change, not just a correction, a trend change overall, swing or trend trade. We had bullish divergence at the lows, or I believe close to it, nice uptrend there, and then a divergent high right here, and that set this downtrend, and now we have this divergent low. So just swing trading those divergences. If they play out, this one could carry us up here to about 109. So that puts the near-term outlook still a little uncertain, a little obscure in my opinion on both Treasury, TLT and IEF. Intermediate term, still bullish, I think, and then longer term, actually bearish. So, but that's like way out there. That's when I pull a 30-year chart, because Treasury bonds have been in a 30-year cyclical bear market, or rates have been in a bear market, going lower and lower and lower, where bonds have been going higher and higher. Or I should say secular bear market. TYX, I'll show you real quick. This is the 30-year Treasury yield. And when you go back long term, really long term, you can see this goes back to the 70s right here. And so the really rates peaked in the early 80s right there. So these are interest rates on the long-term bonds. And this chart's not the cleanest one, but yeah, there it is. There's your downtrend line, nice and clean and simple. So this is the long-term stuff. This tells us, and we know this, central banks, a lot of them went to zero, even negative, interest rates. So at some point in time, it could take years. You're looking at a chart that spans decades, but at some point in time, we will enter a new secular bull market in rates, which will be a bear market in treasury bond prices. But as of now, we're still below this trend line, not even close to breaking it out. These are monthly candles. So I just kind of wanted to paint the big picture. This is where rates have been trending now for decades. But of course, they're at or near the bottom. Now the bottom is close to zero, but we're probably not going to go to zero on a long bond. Okay, next up, and this would also be almost certainly an option to everybody in their 401 type plan, K plan. And again, in swing trading, you can incorporate bonds into your swing trade. Now, you're not going to get rich quick off a regular size position because bonds don't move that much relative to stocks. In a bad day, the stock market's going to drop 5%. In a bad day, bonds might drop 1-2%. But what you do with that is it allows you to then use a much larger position size relative to your overall portfolio. It's all about that beta risk adjustment. I usually do the beta adjusted position sizes, bringing it down on more volatile stocks or sectors we're trading. But when I go to bonds, I'll use sometimes a 2-time or higher position size because of the reduced risk, especially with treasuries. So with that being said, you can incorporate these into a swing trading portfolio or trend trading portfolio or any other IRA type accounts. So the story on LQD, you can see the trend lines. It has uptrend lines, and we've had this pretty sharp ramp here recently. Near term, I'll tell you, this chart isn't very clear to me. I think a lot of the meat on this run has already been milked. We had a divergent low, and that was the catalyst for much of the move here. You can see the divergence right here, positive divergence, just like we had a divergent low here. This chart's not fully annotated. There's your divergent low. That leads to a rally. Can we get that again? Possible, but where we're at in the cycle, probably not. So I don't think so. But if so, that's the next I should say potential resistance. I was about to say pretty decent. It's not even that decent because we only have two reactions so far along that way. A tag there would be a third reaction. So that's a level to watch for. The trend is certainly bullish right now and up in LQD. For those of you not familiar, when I say corporate bonds, these are investment grade corporate bonds. And then when you go down the scale to below the BBB rated, that's the last of the investment grade, then you get into what they call junk bonds because they have a much higher risk of default. These bonds have not a very high risk of default. However, when the ship finally turns for good, meaning the economy, the business cycle goes from expansion to recession, you will see what you do see in corporates, and right now more so than probably any other point in time, is a downgrading a lot of the credit because there's been a tremendous amount of issuance in that lower tier of investment grade, that BBB area, and so what'll happen is, as the economy slows, there will be quite a bit of companies that get downgraded, and what happens is two things happen. Number one, there are, the bond market's bigger than the stock market. There's more money, total value in bonds than in stocks. And what'll happen is, if and when that time finally comes and you start to see, especially if it happens relatively quickly, and sometimes the market will do that, and you start to have a lot of bonds downgraded, the bond funds that they're held in pension plans, your 401k account, LQD, right here, this ETF, by prospectus, they can only hold investment grade bonds. I don't know. They might have a little leeway on how long it can take to sell some. So there's some people, including myself, out there that believe we could see this, a big rush for the exits when if things start to turn quick and all of a sudden everybody decides at once, okay, I need to get rid of those lower grade corporates, because once they go to junk status, not only is it a rating change, but again there will be forced selling by a tremendous amount of institutional funds that again are not allowed to hold junk bonds, or bonds that are triple single B, double B, and lower. So that's something to watch for. And I guess longer term, since we're looking at a weekly chart, what else to watch for? I would say this. This is where things are probably going to get ugly when that level goes. That 111, it's pretty much contained all the pullbacks. You can see I sort of have a support zone here, but anything down below 111, I know it's a ways below. No, percentage-wise, not too much. We're only at 116.64 now, so that's the level to watch. So I favor, just to make it clear, I favor treasuries right now over corporates. Then you have junk bonds. A couple ETFs out there. JNK is one, and HYG is the other. What I see is a pretty clear downtrend line. Again, this is a weekly chart, and so junk bonds, which typically, or historically I should say, trade much more in line with equities than they do with bonds. See, treasury bonds especially tend to go up when stocks go down, and vice versa for that flight to safety bid and some other things, and economic growth and all that stuff. Whereas junk bonds, because these are companies that are on the verge of missing a payment or defaulting altogether, not giving you your money back. So when the music's playing, meaning the economy's chugging along, everything's good, default rates on junk bonds are low, and it's priced in. A couple are going to miss payments or go default, but they're safety in numbers. There's a lot out there, and it's not a big deal. In those that bite the dust, it's more the very high above average returns or yields on the rest of the bonds more than make up for the defaults when things are good. However, when the economy turns, these are the ones. Default rates can spike, they can even surge, and I'm not even going back to the last bear market here. This is just during the bull market. You can see that junk bonds, you can wipe out months and years of gains in very short order in junk bonds. So this is where the biggest risk lies. People are chasing yield, and they have been throughout the entire bull market, with the Fed going to quantitative easing and bringing rates down next to nothing. Investors have been forced into yield, even those that normally wouldn't, or high yield, even those that normally shun risk, because they don't have an alternative. They can't get what they were getting 10 years ago on their corporate bonds and CDs and things like that. So they're chasing returns. So all right, so that's fundamental. Technically, here's a downtrend line. Bullish if we can pop above it with conviction, although there is a pretty decent level right above here to be taken out as well, 36.10. So just where we're at right now, until I'm can really say that, hey, that bearish scenario and the bear market rally thing, the odds of that now are very low. Until I can say that, I wouldn't chase a breakout in junk bonds. There's a lot of indicators that tell us the economy may be rolling over, softening. So this is not the time. 10 years into the longest economic expansion in history, one of the longest bull markets in history, that's not the point to go chasing junk bonds, even if they've got some more upside. It's just like the stock market. The risk reward is just not attractive. So there it is. Now, bearish, from the bearish point of view, if the market rolls over soon, or let's say it doesn't. Let's just say, I'll give you two scenarios. Let's say the stock market keeps going up and junk bonds roll over. That's even worse. This is one of the best indicators, and it has been historically speaking. I watch credit spreads, which are similar to, you can watch, you can go to Fred's site, which is the Federal Reserve economic data site. And you can look at credit spreads and things like that, or you can just follow junk bonds. And when you see a divergence between junk bonds and the stock market, that tells you that is a red flag. And here's the thing: junk bonds peaked years ago. They peaked back in 2013. They have been in a bear market. So just bigger picture, this just doesn't bode well. quantitative easing has just caused a lot of distortion, so stock prices still go up. But if we want to look at technically speaking, this is a trend line to watch, and we've rallied back to that trend line, a strong rally. From those strong rallies usually come when you get these sharp advances, you often get these very sharp reversals as well. So that's something to watch. When you get these sharp runs up, it just shows there was a sort of a mispricing in the market or a quick paradigm shift. And that paradigm shift was, the Fed backing off, pulling a 180 back here. So I just wanted to point out that this is something to watch, and something that also, I think of the three that I've covered so far, in order, where I like them, Treasury's number one, corporate's number two, and this one, not only would I not put money in it, but I'm considering a short entry on here soon. I just need to see the markets, give a little evidence, and I've already covered that in today's video, so we'll wait and see. Yeah, one more thing before I leave this. Let's look at trend indicators. Again, I use this on stocks. I use it on different time frames. It's that simple 9 EMA, the signal line, and within the PPO. And when it's above 0, the trend is bullish, and when it's below, the trend is bearish. So it told you, get out of that mess. Get out, stay out when you had a crossover, bearish crossover. That one wasn't very long. It goes from right about here to here, but it got most of that. Maybe not a timing indicator. And again, when the lines are close, you get more whipsaw signals. But when you finally get clean separation, here you had a sell signal right there, or told you the trend was bearish all throughout there. And from this point on to here, said you can be in junk bonds, and you did well. You got a above average yield plus price appreciation. From this point right here, it said get out. They're in a bearish trend, and they still are. As I often say, that 0 line not only defines bull and bear trends, but it often acts as support or resistance when tested from above or below. Where is it now? Well, that white line is still below. So you have junk bonds rallying back to primary multi-year trend line resistance going back to 2014, with the trend still clearly bearish, despite what might seem like just like the stock market, a rally that can't be stopped. So $1 million question, only time will tell. Is this right here? Is this rally? Oh boy, these drawing tools aren't working for me today. Is this rally this with this to come? Could be. If it breaks out of here, anything's possible. Or will it be one of those other shorter-lived, pops with a drop to follow? All I can say is that time around, we didn't hit resistance or anything, and we're coming off a hell of an oversold correction. So like the stronger the rubber band gets stretched, the more it's going to snap back. That's this time around. I think it's a little bit different. This just looks like a kickback rally to a downtrend in an ongoing bear market in junk bonds, with what could be, and I believe, a lot more downside to come. Oh, sorry guys, I thought I hit pause. I wanted to get this chart polished up. Either way, I was going to end the video there because we wrapped up Treasury bonds, but I did say I'd touch on commodities just because it's a different area. And there's different types of commodity indexes. Some of those, I think it's a CRB, is it? That includes crude oil and things like that. And then you have other indexes that only include their agricultural commodities only. And here's an ETF that tracks ag commodities. I've talked about it recently, and I've been highlighting wheat, corn, other things like that. And it's been this is what we call a secular bear market right here. So commodities have been in a secular bear market since 2010, but they've had cyclical bull markets within, smaller bull markets. And remember, commodities have a tangible value. You're not going to have a earnings miss or a bankruptcy announcement or a CEO scandal. They're always going to be around. They've just been in a downtrend, and it continues till it doesn't continue. And however, there have been plenty of rallies along the way. You watch a technical setup, you can rally. There was a 20% gain right there off the divergent low, and of course you can see the wedges and all the objective entries. I'm trying to get it for you. That should be about 30, maybe 22. and again, maybe another 15 or so percent. So here's what we're watching now, and I'll get to the daily chart in a second. It's just setting up in one big divergent low. We've had these smaller divergent lows. There was divergence right here at this point, and it popped. But this is we're building now multi-year divergence here as this commodity index falls down to levels where sooner or later, since there's so much liquidity, and I've been talking about this for years, it just hasn't materialized yet, that there is a tremendous amount of liquidity sloshing around the financial system, the global financial system, not just the U.S. market. It'll find a home somewhere. So when the equity bubble pops, something's going to be the beneficiary. Whether it's going to be cash, everyone puts their money in cash. People like start buying Bitcoin again, gold, maybe all the above. But I think commodities have a good chance to be the beneficiary of a lot of those inflows. So we'll watch this one, and I'm very open to trying to catch a primary trend change. Take the charts one day at a time. I'll do some updates, and this may become an official trade. Here's the most recent divergent low on the daily time frame I just flipped over to. There's your divergence right there, also on the daily. Nice, strong, bullish divergence. PPO is starting to turn up. I'm liking what I'm seeing recently on wheat and corn. They need a little more work. And I haven't updated this in a while, but back in March, about a year ago, actually, there it is. This would, and it'll be roughly the same. It always holds a pretty good amount of wheat and corn. You can see the percentages there. So if you want a one size fits all or one shot, buy DBA and have exposure to a lot of different ag commodities, and don't worry which one shoots up today and which one shoots up tomorrow. Sometimes I know trading commodities, because they tend to move fast when they go, it can be like a game of whack-a-mole, that little where you go to Chuck E. Cheese or whatever with your kids, and things pop up, trying to get the right one, and then all of a sudden this one goes. So here's a way to diversify and kind of catch them all, if you will. So we'll wrap it up here, and I will do, I'll continue to watch all this stuff. I watch all this stuff every day, and I may not talk about it for weeks or even months at a time, any one particular security or asset class, but I want you to know I'm, keeping an eye on these alternative assets, and we'll continue to try to, put them on as official trade ideas, long or short, when the opportunities are there. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.